With us is Derek Halpenny. He's European head of global currency research at Bank of Tokyo-Mitsubishi UFJ. That bank ranks second out of 55 banks in a Bloomberg accuracy poll on forecasting. Good to have you with us, Derek. So what do you make of the reaction that we've seen in the currency markets with the euro to what's happening at the summit?
Well, I think you've got to put in the context of, I think, where positioning has been. And obviously, we've had a very large move ahead of all of these events that are taking place at the moment, when we saw a major drop from 145 down to 131. And the market was extremely short. And in the run into this meeting, or this summit, there has been a reversal of that move. But certainly I would say there is also a degree of optimism. And I think the history of summits, important get-togethers like this in Europe, is that there does tend to be an initial phase of risk-on optimism. The measure's been taken well, and that has resulted in the euro moving a little bit higher. So for those who were short, there was a concern that that would happen again, and therefore those positions have been covered. So I think that's a large part of why the euro has performed so well.
Now, isn't key here what actually is going to happen to Greece and how much of a haircut the bondholders are going to take? Is that the sort of sticking point that is really affecting the euro at the moment? That's what everybody's looking at.
Yeah, I think, you know, there's the well-known kind of three-pronged attack in terms of bank recapitalisation, the EFSF and Greece. And I think to have a real credible plan, I think all three have to be tackled in unison. So I think the markets are watching for everything. But I would agree with you. I think at the heart is Greece and how that's dealt to. Well, if you don't get rid of, and I mean fully 100%, if you don't get rid of the uncertainties related to Greece, then the other two issues become less credible in terms of the measures that may be put in place to deal with bank recapitalisation and firewalls in regard to the size of the FSF. So unless you deal with Greece, I think the other two measures could be counterproductive or
dealing
not.
with Greece, is that a 50% haircut, a 60% haircut, a 40%? What deals with it once and for all?
Well, you know, I think there needs to be, I think when you look at the overall level of debt in Greece, if you get debt down to something like 80% of GDP, and that's a 50% reduction on all debt outstanding, then I think you're into a level in which potentially Greece can get out of it. But of course, you've also got to remember that even if you got down to 80%, you had a massive 50% reduction on all holdings, Greece still isn't running a primary surplus. So in other words, it's still going to have to deficit finance, possibly for the next 2 years. According to the report from the IMF, things are getting worse.
Right.
And the measures that were put in place and the assumptions on growth just 3 months ago are already out of date. And I think that just tells you the problems that Greece has at the moment.
We don't have a great deal of detail on anything that's coming out, but we do have a bit more detail on what the proposals are for the banks. They apparently need to find some 108 billion euros. Is that enough?
Well, it's obviously an excellent start if we were to get that. My problem is that there doesn't seem to be a great sense of urgency. If you recall back to the collapse of Lehman's, now admittedly the markets were in a different state at that point in time, but there was no period of, well, the banks can go out and look for it, and then if the banks don't get it, then the government might help, and if that doesn't happen, then we can go to TARP. It was straight in, get recapitalised and do it urgently. This time there's a 9-month period, I think, possibly. The banks can do it themselves, then the governments, then the EFSF. And I think that's a dangerous type of plan to have in place. And the danger, of course, is that the banks try to address this through aggressive reductions in the asset size of the balance sheet.
So interesting, actually, when you look at the euro at 139, it's significantly higher than its average since it's come into existence, certainly. But does it deserve to be at that level on fundamentals, or is this more about weakness in the dollar or other currencies?
Well, yeah, when you go back over time, there are periods, and a considerable number of periods, where it really is a dollar story that has impacted euro dollar. You know, if you take we have a G10 basket on a trade weighted basis versus the euro, and it's down over 20% since the financial crisis in 2008. So there's a clear trend in place in the euro on a trade-weighted basis. But of course, everybody focuses on euro-dollar, and that's a story of two different places. And importantly on that point, it's worth remembering Governor Tarrillo's comments at the end of last week, where he signalled the potential for the Fed to come back in on a third round of quantitative easing and going back into the mortgage securities market as the assets to purchase in a third round of quantitative easing. And that did hit the dollar on Friday.
So if we're talking just about the euro, just about the Eurozone, 138, does it deserve to be there on the fundamentals?
Just on the euro alone, no. You know, we have a forecast of euro-dollar moving down to about 125.
By when?
End of year into the first half of next year. It's our 6-month forecast.
And is there anything that you're looking at to say, you know what, that will be the trigger to send the euro plunging?
Well, we think and by the way, a 125 figure is on us muddling through. It's no disaster. And really what we think it comes back to is the basic fundamentals. We think the ECB will have to cut rates back to 1%. We think there's a very good chance we'll get a recession, or certainly 1 quarter of contraction, possibly in the first quarter of next year. And simply the fundamentals in Europe relative to the United States, where things are actually looking a little bit better than the markets had expected. We're going to get GDP growth this week, possibly over 3%. Some are saying 3.5%. And therefore, the relative fundamental picture is, we think, more favourable for the United States. Now, if QE3 was to come in, we would possibly have to temper that. But certainly, the laws of diminishing returns are also kicking in, and we don't expect the same impact from a third round of quantitative easing as from the first two.
What if muddling through ends up being a bit more painful than you anticipate? I mean, the banks do have to recapitalize. There could be a shock to the economy, to growth. You're saying 1 quarter of negative growth. What if it's more?
Sure, if we were into a nastier situation where there's a credit event, let's say a financial institution collapses, that kind of scenario where we see big equity falls, I think obviously the foreign exchange markets are going to be far more volatile. What we will initially get is the dollar performing very well. 125, certainly much lower than that. But then, of course, the probability of quantitative easing 3 from the Fed is higher. So then
because the situation in Europe is deteriorating.
Exactly,
yeah.
And that would encourage that. So more volatile, but a lower point in euro-dollar.
We shall see what happens. Good to talk to you, Derek Halpenny from Bank of Tokyo-Mitsubishi UFJ. Thank you very much indeed for your insight today.